Assalamu alaikum friends, welcome to lecture 23 of SBR, IAS 40, Investment Property. This is a very short lecture, but it is also a very easy standard when compared to other standards on assets. So we are going to go through the definition of investment property, the measurement, the transfer, and the disclosure. Investment property means any asset, whether land or building, that is held for rent or for capital appreciation. That means if the value of the asset goes up, you are going to get the benefit by having a land or by having a building, right? Even if you are giving it as a lease under an operating lease to someone, it is still considered as an investment property. Okay, if you are giving it on a lease. Okay, examples of investment property. You need to be very careful in SBR exam. Why? Because when assets are given, you need to know whether it is a tangible asset. Okay, and you need to know whether it is an investment property or an intangible asset or a financial asset, because assets have many classification. Okay, it could be an investment property. If it's an investment property, it is dealt according to IAS 40. If it is not an investment property, it is, and if it's tangible, IAS 16. Intangible, IAS 38. If it's a financial asset, it's IFRS 9. So you see there are many standards that deals with assets, because there are various classifications of assets. So investment property is one of it. When you're holding the asset to gain rent or for capital appreciation, then it's an investment property. These are the examples. Land held for capital appreciation, land held for undecided future use. If you're having a land and you don't know what to do with it in the future, still it is an investment property. Building that is leased out under an operating lease. Remember, operating lease, not finance lease. Okay, these are not investment property. Similarly, you also have to know the opposite, which are not an investment property. Property that are held for use in the production or administrative purpose, they are dealt according to IAS 16. If it is used for sale in the ordinary course of business, it is IAS 2 inventory. If the asset is constructed on behalf of a third party, IFRS 15 revenue. If it is an owner occupied property where owner is staying, again IAS 16. And if the property is leased out under finance lease, IFRS 16 applies. So these are not investment property. Measurement. Initial recognition is cost. Subsequent, you have a choice, cost or fair value. These are same like tangible and intangible asset, right? IAS 16 and IAS 38 follows the same up to here. Then the policy chosen must be applied to all investment property. Remember, if you're choosing cost, it applies to all investment property. If you choose fair value, all investment property, fair value. If it's a cost model, okay, investment properties are held at less cost, less accumulated depreciation. No revaluations are permitted. Remember, if you're using cost model, and if fair value model is used, again there is no depreciation that is charged. Okay. Gain, the difference comes here. All gain and losses on revaluation goes to profit and loss. Whereas in IAS 16 and IAS 38, all gain and losses on revaluation goes to other comprehensive income. But when it comes to IAS 40, investment property, it goes to profit or loss. In exceptional circumstances, if you are not able to measure the fair value, then you can adopt the cost model. Okay, transfer. Okay, transfer to or from. You're transferring another asset to investment property or investment property to some other asset. Both ways you have to know the rules. Okay, there are 4. Okay, so you need to use the fair value at the date of the change for subsequent accounting under IAS 16. The first one is where you are transferring the investment property to an owner occupied property. Owner occupied is IAS 16, remember. So from IAS 38 you are changing to IAS 16. How do you deal with it? You use the fair value up to the date of the change. Okay, use the fair value at the date of the change for the subsequent accounting under IAS 16. Next is transfer from investment to inventory. Here you use fair value up to the date of the change under IAS2, because after the date it will be dealt according to IAS2. Then owner occupied to investment, the other way around. Earlier it was investment to owner, now owner to investment. Then when it was in owner, normal IAS 16 rule applies. Okay. After that, IAS 38. Okay. And if you are using fair value, remember any increase in fair value goes to other comprehensive income. And if the fair value decreases the value, it should be charged to profit. Please understand that if the fair value increases, okay, on adopting fair value, normally the value increases, right? If the value increases, it is credited in other comprehensive income. If the fair valuation causes a decrease in value of the asset, it is dealt in profit and loss. Understand this. You will understand this better when we are doing a question. Transfer from investment to transfer from inventory to investment is any change in the carrying amount caused by the transfer will be recognized in profit and loss. So in short, everything goes in profit and loss. Any revaluation gain or loss. Nothing is dealt in other comprehensive income. The only thing that is dealt in other comprehensive income is the third point. When you are changing the owner occupied property to investment property. Okay. There when you are having a fair value. Okay. Any value in other comprehensive income. If it increases, if the fair value increases the value, only that time other comprehensive income. All the time it is profit and loss, profit and loss, profit and loss. This is the easiest way for you to remember IAS 40. Last but not the least, the disclosure. You need to disclose whether the cost model is used or the fair value model is used. The amounts that is recognized in profit and loss. Reconciliation between the carrying amount at the beginning and the end of the investment property. Fair value of the investment property if the entity uses the cost model. Because sometimes it's not easy to get the fair value. But you have to disclose it even if you're using the cost model. So that's it. Now we'll be doing questions before we summarize IAS 40. The first question, illustration 1. So here, how the property should be treated in the financial statements for Lavender. Lavender owns a property which it rents out to some of his employees. She owns a property, okay, which is renting out to employees. It was purchased for 30 million on 1st of Jan 2002. Useful life was 30 years from that date. On 1st of Jan 2007, that is after 5 years. Okay, from 2002 to 2007, 5 years have gone. Market value was 50. Remaining useful life remain unchanged. Management wished to measure properties at fair value. Okay. First, you need to identify whether this is an investment property or not. Okay, whether it has been a shift to investment property or from investment property to some other asset. So since this property was owned, you see the word owned, and it has been rented to employees. This is not an investment property. It is an owner occupied. You see, it's an owner occupied. It is not an investment property. So because it is owner occupied, which standard applies? IAS 16. You have to apply the rule of IAS 16, not IAS 40. Okay. And they have already told you that they are wishing to measure at fair value. Okay. So now, any changes in fair value, any revaluation gain will go to, because IAS 16, it will go to other comprehensive income. Okay. So now you need to find out before revaluation what is the amount, after revaluation what is the amount. So let's do that. Okay, before revaluation, building had a carrying amount of how much? You have to deduct the 5 years worth of depreciation. Okay, so it has been 30. From 1st of Jan 2002, from 1st of Jan 2000, useful life was 30. But after 5 years, useful life will be 25 years. Remaining useful life will be 25 years. So 5 divided by 30 into 30. it will be 5. Depreciation is 5. So from 30 you minus the depreciation, it will be 25. So 25 is the carrying amount before depreciation. Okay, now you see the total building was revalued to 50 million. So from 25 it went up to 50. That means there's a 25 gain. This gain will go to other comprehensive income. Okay, and what about the depreciation after 5 years? On 31st December 2002, at this date, again you need to depreciate. Okay, over 25 years. So that time it will be 50, the revalued amount, 50 divided by 25 years. Depreciation is 2 years. Sorry, 2. Okay, so from 50, you deduct this 2 depreciation and it's 48. This is the carrying amount in 2007. Okay, now we'll be moving on to the next question. Illustration 2. A, B, C. Discuss the accounting treatment for the year ended 31st December 2001. Okay, on 1st of Jan 2000, okay, see, they were owning a building. Okay, and on 1st of Jan 2001, the building was measured under the cost. Carrying amount was 500. On this date, the fair value was 600. ABC values the premises. However, the debtor decided to keep the building in order to rent it out to tenant. So from this date, they have changed it to investment property. Okay. Measures the investment property at fair value. Property had a fair value of 625,000. Now, before the change, you have to account it according to IAS 16. Okay. Because it was owner occupied. Now, first let us work out the revaluation. So from 500 to 600, it changed by 100. So this 100,000 gain will go to other comprehensive income according to IAS 16. Okay, 100,000 gain will be in other comprehensive income. Correct. After that, investment property is remeasured again, measured at fair value from 600 to 625,000. But this, okay, so from 600 to 625,000. But this gain will go to this 25,000 gain will go to profit and loss because it is under IAS 40, sorry, investment property, because that is the rule. The rule says so. And what about depreciation? Investment properties that are held at fair value are not depreciated. I repeat, investment properties held at fair value are not depreciated. Just before this in the previous slide, we have mentioned it, right? Now, test understanding for the last question. This question, test understanding for all, is more of a discussion question. Okay, so I'm not going to write the answer. The answers are there in your textbook. You can read the answer, take your own time and read it. But this answer is with reference to conceptual framework. The question is, what factors are important when you are considering the choice? You have been given a choice in measurement basis, right? Cost of fair value. What are the factors that you take into consideration for the preparers when you are allowed to make a choice? On what basis you make the measurement choice? Referring the answer to conceptual framework. Okay, this is the question. So let us read a little bit of the case study. The directors are considering purchasing an investment property for the first time. Okay, property prices are rising. This is a fact. Okay, and they are going by IAS 40. They have a choice. Okay, they are unsure of the factor when selecting a measurement basis. So I will give you the points. You can make up your own answers, and obviously the answers are there. Okay, the two choices are what? One is cost, the other one is fair value. These are the two choices. Okay, now the three important thing. Okay, I will give you the points. One is relevance. You have to make sure that your answer talks about these 3 points in your answer: relevance, faithful representation, and comparability. Okay, this is regarding the measurement basis. Whatever the measurement basis you are choosing, whether cost of fair value model, it has to be relevant, it should be faithful represented, and you have to be able to compare. Okay, now you need to talk about these 3 points in depth, which I'm not going to do. Answers are there, but I'm going to explain you the points. Let's start with relevance first. Relevance means you have to choose that measurement basis which is more relevant. Okay, and to achieve this, how do you say it's more relevant? It is based on the characteristics of the element. Element means the type of the asset it is. Some assets is easier to go by the cost. Some asset you is easier to get the fair value. So for that you have to use the fair value. So it is based on the characteristics of the element. Okay, this will further break it down. Characteristics of the element. Okay, you have to talk about this and how it will contribute to future cash flow. Second point. These are the two important points. Okay, you have to talk about. So link this to the case study now. Relevance. We are still in the relevance. So they are saying property prices are rising. So in this case, tell me which is better, fair value or cost model? If you are using the cost model, remember, because prices are rising means fair values are also increasing. Okay, fair value of the many properties will rise over this time. So if you're using the cost model, it is very different from the fair value price. So it is not going in line with the rule of IAS 40. So using cost model in this case is not suitable. It's not even recommended also. Okay. And even if you're using the cost model, remember, any changes in the fair value needs to be disclosed. Okay. And changes in the fair value of the investment property would not be recognized until disposal. When you dispose only, you will know the fair value. You do not recognize before that. Okay. And the business model would seem to be based on selling the investment property. It is based on the house business model, whether he's in a hurry to sell the investment property or he wants to keep the investment property, right? If he wants to sell the investment property, fair value is more suitable than the cost, because that will provide more relevant information and information about the future cash flow. Because through selling the investment property, you know how much is your future cash flow. You can predict if the business model is selling. Okay, in that case, fair value is more relevant. Now we are coming to the faithful representation. Second point. Okay, how are you going to explain this? See, you should just not simply select a measurement basis that gives you the most favorable return. Okay, you might want to inflate the value of the asset by choosing the fair value, or because you want to show less of the depreciation, you might use the cost model, right? Because whatever you see is favorable, but you should not simply choose the measurement basis according to that. What is the key factor here? Degree of measurement uncertainty. Degree of measurement uncertainty. Here, for faithful representation, it is degree of measurement uncertainty. So here, what are you going to talk about degree of measurement uncertainty? What does conceptual framework talks about it? Sometimes if a thing is very difficult to measure, if it is so uncertain, it outweighs all the other factor. You only go by this. If it is very this thing, if measuring the fair value is very uncertain, very difficult, you don't choose the fair value. Okay, even if it is more relevant or even if it's easy to compare, sometimes this one single factor outweighs the other factor, measurement uncertainty, and if it's very high, then the cost would be more suitable, right? Because even if you measure it, for example, if you're using fair value but the measurement uncertainty is very high, even if you give them, it will not be so relevant. Relevance will be very little. Okay, so you have to see this, the measurement of uncertainty, right? Let's say for most buildings, okay, you can determine fair value using level 2. IFRS 13 we are talking about. There are 3 levels in measuring fair value. We have not yet touched IFRS 13, but let me briefly tell you IFRS 13 that there are 3 levels in measuring fair value: level 1, level 2, and level 3. Level 1 is the most preferred method, most safest and most preferred method. Why? Because it is for identical products. Prices are easily available and there's a huge active market for it. Level 2, it is still preferable, but it is not the best. It is better than level 3, but not the best. It is for similar products. Okay, some adjustments need to be made. Level 3 is the most riskiest, which we don't recommend usually. It is based on your cash flow projections and all. It is prices are not easily available. You have to make your own predictions based on cash flow predictions and all. So for most buildings, it might be level 2. Okay, you get the fair value through level 2. But if what if the building that you have purchased are unique? Then it's level 3, right? Which is more difficult. So it's more difficult to get the fair value. But even if the fair value is done through level 3, it is still preferable than the cost, using the method using historical cost. Why? See, you can use level 3. It is preferred over cost as long as the estimates that you are using for level 3 are are using the best. That means they are from the best information that is available. If you are basing your estimates based on the best available information, okay, and you have disclosed that there are measurement uncertainty, you have disclosed it, then level 3 fair values are better than historical cost in that condition. If the estimates that you are relying on to predict the fair value is not correct, if it's not accurate, then you have to go by the cost model. I hope I'm able to make it clear for you. Now we are moving on to the third, compare. This is a little easier to explain, that, right? You use financial information, you use a measurement basis which is easier to compare with the other entities. Okay. For example, you might use cost model if you see that other people also in the same industries are using cost model. So it's easier to compare. Okay. So that's it. And now we'll be summarizing IAS 40. So we started IAS 40 with definition. We said that it is property that is held for capital appreciation, for rent, building that is leased under an operating lease. And we also went through those properties which are not investment property. They are dealt according to IAS 16, IAS 2, IFRS 16, IFRS 15. Measurement. Initially at cost, later fair value is also there. If there are any gain and losses on revaluation, they are reported in profit and loss. See, this is different from IAS 38 for intangible assets and IAS 16 from tangible assets. There, gain and losses on fair value goes to other comprehensive income. But in IAS 40, it is in statement of profit and loss. And if it is impossible to measure fair value, use cost model, even if the choice is given. Transfer. Transfer from investment to owner, transfer from investment to inventory, from owner to investment, from inventory to investment. you have to know the adjustments. So that's it for this lecture, and see you in the next lecture, that will be IAS 41 agricultural properties, the last IAS standard, because after that we'll be moving on to IFRS standards, IFRS 1, 2 and so on. Meanwhile, don't forget to subscribe to my channel if you haven't subscribed, so that you get the notification of my latest videos. And there's a whole playlist on my SBR lectures. You can watch all the lectures from 1 to 22 up till now. All my lectures will be uploaded and saved in that playlist. Thank you and take care.